Welcome to video 2 of your NMLS Safe Exam Prep series. Today's topic is TILA, the Truth in Lending Act, implemented through Regulation Z. TILA is one of the most heavily tested laws on the entire exam. It covers how lenders must disclose the true cost of credit when borrowers can cancel a loan and the rules lenders must follow to make a qualified mortgage. Let's get started. TILA stands for the Truth in Lending Act. It was enacted in 1968 and is implemented through Regulation Z. It is enforced by the CFPB. TILA's primary mission is to ensure that consumers receive clear, accurate disclosures about the cost of credit before they borrow. The most important disclosure under TILA is the annual percentage rate, the APR, which gives consumers a standardized way to compare the true cost of different loan offers. The annual percentage rate, APR, is the centerpiece of TILA. It represents the true annual cost of the loan, including the interest rate and certain fees spread over the loan term. APR always equals or exceeds the note rate because it includes more costs. What is included in APR? The interest rate, origination fees, points, mortgage insurance premiums, prepaid interest, and certain broker fees. What is not included? Appraisal fees, title insurance, recording fees, transfer taxes, and homeowners insurance. Now the most tested TILA advertising topic: trigger terms. A trigger term is any specific number in a mortgage advertisement that, when used, requires all additional disclosures to appear in the same advertisement. Trigger terms include a specific interest rate, a specific monthly payment, a specific loan amount, a specific down payment amount or percentage, and specific closing cost amounts. When any one trigger term appears, all 5 required disclosures must also appear in the same ad: the APR, the down payment, the repayment terms, the amount of each payment, and the number of payments. Here is the most practical part of trigger terms: knowing what language is safe and what pulls in all the disclosures. Unsafe trigger language: specific numbers, 5.5% interest rate, only $1,299 per month, 5% down, 0 closing costs. These all trigger the full disclosure requirement. Safe language: vague terms that require nothing additional. Competitive rates available, low monthly payments, flexible financing options, call for today's rates. The key insight is simple: specific numbers trigger, vague language is safe. APR has its own special advertising rules beyond trigger terms. First, APR alone can be stated in an advertisement without triggering all the other required disclosures. Second, if you state a specific interest rate, the APR must also appear with equal or greater prominence. You cannot put the interest rate in large headline font and hide the APR in tiny footnote text. That violates TILA's clear and conspicuous standard. Third, for adjustable rate mortgages, the APR must disclose that the rate can increase after the initial fixed period. The right of rescission under TILA. Section 125 gives borrowers 3 business days to cancel certain mortgage transactions after closing. The rescission right applies to refinances on a primary residence, home equity loans on a primary residence, and HELOCs on a primary residence. The rescission right does not apply to purchase money mortgages, vacation homes, investment properties, or commercial properties. If the lender did not provide proper notice of right to cancel at closing, the rescission period extends from 3 days all the way to 3 years. Business day counting for rescission is a frequent exam topic. For rescission purposes, business days include all days except Sundays and federal holidays. Saturday counts as a business day. The 3-day count starts the day after closing. Closing day itself is day 0. If a federal holiday falls within the 3-day period, skip it and extend the count. If Sunday falls within the period, skip it and extend the count. The deadline expires at midnight on day 3. The Ability to Repay Rule, ATR, is a Dodd-Frank amendment to TILA, requiring lenders to make a reasonable, good faith determination that the borrower can afford the loan before originating it. The ATR rule requires lenders to verify at least 8 factors: current income and assets, employment status, the monthly mortgage payment, other monthly mortgage obligations, other monthly debts including alimony and child support, the debt-to-income ratio, credit history, and monthly housing costs. Approving a loan based only on a credit score without actually verifying income is a clear ATR violation. The Qualified Mortgage Rule, QM, provides lenders with a legal safe harbor against ATR claims. When a loan meets QM standards, the lender is protected from claims that they failed to verify the borrower's ability to repay. Standard QM requirements: maximum DTI of 43%, points and fees capped at 3% of the loan amount for loans of $100,000 or more, maximum loan term of 30 years, 40-year loans are not QM, and no balloon payments, no negative amortization, and no interest-only periods. The QM points and fees cap is one of the most calculation-heavy NMLS exam topics. For loans of $100,000 or more, total points and fees cannot exceed 3% of the loan amount. Example: loan amount $250,000. 3% cap equals $7,500 maximum. If actual fees charged are $8,200, that exceeds the cap by $700. This loan is not a qualified mortgage. The lender loses the ATR safe harbor protection. Always calculate loan amount times 3% equals maximum allowed fees. Exam traps for TILA. Trap 1, purchase money mortgages have no right of rescission. Trap 2, APR alone does not trigger all disclosures. It is the specific interest rate, payment, or loan amount that triggers. Trap 3, Saturday is a business day for rescission counting. Only Sundays and federal holidays are excluded. Trap 4, ATR requires actual income verification. Credit score alone is never sufficient. Trap 5, if proper rescission notice was not given at closing, the period extends to 3 years. Trap 6, 40-year mortgages are not QM. Key numbers for TILA. Write these down. Rescission period: 3 business days after closing for primary residence refinances only. Rescission extension: 3 years if proper notice was not given at closing. QM DTI cap: 43% maximum for standard non-GSE qualified mortgages. QM points and fees cap: 3% of the loan amount for loans of $100,000 or more. QM maximum term: 30 years. APR prominence rule: APR must be at least as large and prominent as any stated interest rate. Business days for rescission: all days except Sundays and federal holidays. Saturdays count. Quick recap of TILA. TILA stands for Truth in Lending Act, implemented by Regulation Z, enforced by the CFPB. APR equals the note rate plus fees. It always equals or exceeds the note rate and enables true cost comparison. Trigger terms: any specific rate, payment, or amount in an ad requires all 5 disclosures. APR alone is safe to advertise, but must be as prominent as any stated rate. Rescission: 3 business days for refinances on primary residences only. ATR must verify 8 factors. Credit score alone is never enough. QM: 43% DTI, 3% fees, 30 years maximum, no balloon, no negative amortization. That is video 2 of your NMLS Safe Exam Prep series. In video 3, we cover Tier ID, the TILA RESPA Integrated Disclosure Rule. We will go through the loan estimate, the closing disclosure, tolerance buckets, and changed circumstances. These topics generate some of the most scenario-heavy questions on the entire exam. Watch video 3 next. Keep the momentum going. You are building real exam competency. You will pass this exam. See you in video 3.